With the US inflation report this week coming in at 3.5%, higher than what the economists were anticipating, we can now see that the expectation for the earliest rate cut is going to be in September. Whilst a lot of economists were hoping that June would be the first month where we would see this Fed rate cut, we can now see that September is looking like, if at all, in 2024 to be the earliest opportunity for this policy easing. Now, we do in fact see reports from CNN in fact talking about how the Fed may not even be done yet, and there is potential this year for them to increase those interest rates. Having said that, we do take a look at past performance of the Fed tightening cycles, and we can see, historically speaking, once they are done and rates do cut down, we can see every single quarter public real estate significantly outperforming the equity market. With that being said, then in today's episode, we are taking a look at 5 undervalued REITs with some significant upside to buy before those interest rates do come down and these REITs do tend to shoot up. On top of that, in today's episode, we are going to take a look at a US REIT ETF for those that do prefer to look at ETFs as opposed to buying individual stocks. Now, each one of these that we do review, we will focus on their dividend safety, as that is an important aspect of these real estate investment trusts, as well as lots of other metrics to gauge the future of this business and the historical performance. And we're going to run each one through the valuation model, getting to our intrinsic value, getting to our acceptable buy price given our investor margin of safety, and look towards Wall Street to see their forecast for the next 12 months. So without further ado, let's jump straight into stock number 1. We have REXR, Rexford Industrial Realty Incorporated. Now, as we can see straight away, both Seeking Alpha Analysts and Wall Street indicate this to be a buy. We can see it does trade towards the 52-week low and is down around 17% over the last 12 months. Now, over the last 10 years, do bear in mind this doesn't include those dividends reinvested, so it would be higher. It is up around 236%. We can see it has hit its all-time highs twice over the last few years at around the low 80 mark, and it does currently offer a yield of 3.51% and a P to FFO of just over 20. So in terms of their dividend safety, well, 81, it is very safe. Market cap, 10.3 billion. It is a large cap company. In terms of recessionary metrics, well, we can see we don't have that data available, but we will look to that for the other REITs on today's episode. Very, very strong dividend increase this year, only a few months ago at 9.9%. Over the last 5 years, double digits. Over the last 10 years, double digits. So a very strong dividend growth REIT. And we can see they have been increasing those dividends for the last 10 years. Now, dividend yield theory, it states a company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation. We have another sign of undervaluation with the forward P to AFFO as well above, or in fact below, the 5-year average of 39.4. And when we compare it to the real estate sector P to AFFO, it is lower at 13.5. But do bear in mind, we don't look at any of these models in isolation, and we will conclude towards the end. With the majority of the companies we review on this channel, we do focus on the free cash flow. However, for REITs, they are a lot more volatile, so we will draw your attention to a better metric, the adjusted FFO payout. Now, what we want as a blanket rule for the majority of REITs below 90%, and we can see over the last 10 years it has been below that. 2023 it came in at 88%, and they did offer that very strong 9.9% yield. 2024 expected to be there or thereabouts as well, so no worries based on that. We then look at the adjusted funds from operation. It has more than doubled over the last 10 years. It is also expected to increase to $1.90 next year as well, so that is a positive sign. When we look at the actual growth, AFFO per share percentage-wise, looking very strong and healthy year on year. 2024 as well, expected high single digit at 9%. And for REITs, we want to see 5 to 10% growth on the top line year on year. This is a fast-growing REIT and definitely an undervalued and under-the-radar one that isn't really talked about in the community. In terms of numericals, well, they have grown their top line, as we can see, more than 10 times over the last 10 years. But unfortunately, very typical with REITs, they will dilute your position. We can see that clearly here with the shares outstanding increasing. Essentially, they need to do this to fund those property acquisitions, as they don't have a lot of internally generated cash flow after paying out those dividends. Now, one area that they do lack a little bit, we would like to see a higher return on invested capital. For REITs, we want to see 3 to 5%. What we do know, however, it has increased, and nice to know in 2023 we see 3%. This is something we want to see at a bare minimum moving forwards. Operating margin, also very nice to note the operational efficiency over the last 10 years. It has been increasing from a very low figure in 2014, 37% in 2023, looking very strong and healthy. In terms of the net debt to EBITDA, so this is the earnings before the interest, tax, depreciation, amortization. What this metric shows us, well, one, it correlates to dividend safety, and two, balance sheet strength. We want to see below 5.5, and it has been decreasing year on year, which is a positive sign. And these numbers essentially show us the number of years it would take the company to pay off all of their debt net of cash on hand. 3.42 expected in FY24, very strong, and now we can understand why that dividend does look to be safe, as well as focusing on that AFFO payout. Now, jumping into the valuation, as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Typically on the channel, we do deep dives of these companies. We run through every single one of these models, getting to the intrinsic value. And as we can see in today's episode, the intrinsic value for REXR is arriving at $62. Now, with a price of $48, we always start on 10%, and we typically execute on this if we believe it meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. And then we pretty much keep going till it's near the current trading price, and we can see for today's episode, it is sitting at a margin of safety, the MOS level, between 20 to 25%. In terms of Wall Street and their forecast, well, they see some strong upside, in fact, just under $60, so near enough our intrinsic value, with a price target of 60 and upside of 24%, indicating a strong buy. As always, as we go through these stocks, do drop your thoughts in the comments below. Let us know if you are adding or if they are on your watch list. Also, just to let you know, we have released our latest free weekly article. If you want to gain access to this, where we talk about 10 stocks with massive upside, as well as a few previous articles, one more recently where we run through 10 undervalued dividend stocks, all completely free. Just click on that pinned comment below to sign up and you do get instant access. The second undervalued REIT with a lot of upside, it is EQIX. Now, this is one that is up around 9.5% over the last year. Over the last 10 years, strong performance as well, up 368%. It does currently trade in the mid to lower end of the 52-week range, with a pullback from the recent all-time highs that we did see of $915. Now, the yield is sitting at 2.2%, a P to FFO of 30.74, and we can see both Seeking Alpha and Wall Street analysts indicating this REIT as a buy. In terms of dividend safety, another very safe score of 86. Market cap, 73 billion, a large cap company. In terms of those recessionary metrics, while they didn't pay a dividend in 07-09, they had above average growth, 25%, with the S&P at negative 12, and we can see they pretty much had a near S&P return, negative 56 versus the S&P's negative 55. An incredibly huge dividend increase last October, and over the last 5 years they have been increasing it double digits year on year, so that is a positive thing to note, and they have been increasing those dividends for the last 8 years. In terms of dividend yield theory, we do get that double undervaluation signal. The yield is higher than the 5-year average, with the forward P to FO sitting below the 5-year rolling, but we do note it is higher than the real estate sector P to AFFO. Now, in terms of the adjusted funds from payout ratio, significantly lower than 90% and consistently as well, 2024 expected at that 49% point. In terms of the AFFO per share, well, we do see increases pretty much year on year. 2024 expected more of the same. And when we look at the percentages, we can see, in fact, 9% over the last few years, 9% expected in 2024. This is a very strong REIT to consider for the portfolio, and they are hitting that 5 to 10% level at a minimum pretty much every single year. Numerically speaking, then, they have grown their top line as well at a very rapid rate. But again, with REITs, very typical, they have diluted your position. Do know as we go through today's episode, some of the REITs will dilute your position at a much slower rate. In terms of the ROIC, now it started off very high at 7%, but we can see it has come down to 3% in 2023. As we mentioned, this is the real minimum borderline that we want to see for any REITs in particular. In In terms of the operating margin, very inconsistent. It has decreased. At a minimum, we want to see 12%, so potentially keep this on your radar when you are looking at their next quarterly report and annual report. Nonetheless, it is still sitting above what we want to see as a minimum. Net debt to EBITDA hasn't once gone above the 5.5. In fact, 2024 at 3.46 is a testament to this company, their balance sheet strength, and again, similar to the previous REIT, that dividend does look to be very secure. So let's jump into the valuation as well. Bear in mind, you can grab a copy of this valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio and those on your watch list by clicking below. Margin of safety of 10%, a buy up to $820 at 15%, pretty much spot on at the current price. So for this REIT, we do see a 15% MOS level. How about Wall Street? Well, they see 20% upside. They have a price forecast going higher than our intrinsic value at $930. So we are seeing some nice upside right now in the REIT industry. Moving on to the next undervalued REIT with some nice upside, we have Prologis, now down 2% over the last 12 months. It is trading in the mid to upper end of the 52-week range. Again, both analysts considering this company to be a buy with a yield of over 3% and a P to FFO of just under 22. Over the last 10 years as well, we can see they are up 193%, although they are a little bit away from their all-time highs, sitting around that $170 mark. In terms of dividend safety, well, 61, it does look to be safe. Market cap 111 billion. It is a mega cap company. Now, in terms of their key metrics in the last recession, it is important to note they did cut the dividend. They had below average growth, and they also significantly trailed the S&P. In terms of dividend growth, however, some strong increases, double digits just a couple of months ago. 13% over the last 5 years, although we do note 0% over the last 20 years, as we can see that dividend cut we mentioned during the last recession. In terms of increases, though, they have been increasing their dividend over the last 10 years, and when we do take a look at dividend yield theory, we do again get that double undervaluation signal. When we do compare it, though, real estate sector P to AFFO does sit much lower. Now, in terms of the adjusted funds from payout ratio, what we do note here is that it has been below 75%, which is being industry specific for this company for the majority of the last 10 years, but we can see it is edging higher than that at 87% expected next year, so something just to keep an eye on. In terms of the increases, adjusted funds from operation per share, we do see the increases, although we do note in 2022 it did come down into the following year, and 2024 we are expecting an increase, hence why we do see that share price drop over the last year, and we can see that in clarity in terms of the percentages. In terms of growth, they are still growing at a very rapid rate, and it does look like it has been increasing over the last 10 years. 2023's latest annual report showing a 33% increase to their top line, and they have increased more than 4 times over the last 10 years. And again, we can see those shares outstanding increasing year on year. In terms of the ROIC, pretty consistently over the last 8 years, around 3 to 4%, the more recent year at 4%. Operating margin, nice operational efficiency, 41 over the last 2 years, looking very attractive for REIT investors. In terms of industrial REITs, we bring it down to 5 as opposed to 5.5. We can see it has been trending down, although very, very marginal year on year. 4.84 is a positive sign for this company, so the dividend does look to be safe, as well as that balance sheet does look to be secure. So in terms of the intrinsic value for this REIT, we can see in today's episode it comes to $148. Now with a current price of around $120, we can see on a 10% margin of safety, it is a buy up to $133. At 15%, $125. It isn't quite there yet at 20%, but not too far off. So for today's episode of Prologis, around a 15 to 20% MOS level. Now, in terms of Wall Street and their forecast over the next 12 months, 146 price target, pretty much in line with our intrinsic value, an upside of 22%. So far, these 3 REITs all have a minimum 20% or more increase over the next 12 months. The next REIT that we are taking a look at, it is Alexandria Real Estate Equities. Now, we do see this as a strong buy signal from Wall Street. It is pretty much flat over the last year. Over the last 10 years, up 77%, but we can see it has fallen from the highs of $223 at the back end of 2021. Currently, it is trading towards the upper end of the 52-week range with a yield of over 4% and a P to FFO of over 13. In terms of dividend safety, it is safe, 76 score, 22 billion large cap company. And when we focus on those recessionary metrics, similar to the previous REIT, not the greatest period where they did cut that. They did, however, have above average sales, but they did significantly trail the S&P. In terms of dividend growth, well, 5% over the last full year, which is above the 4% we advocate on the channel. Last 5 years, 6%. Last 20 years, at a minimum, they have been increasing those dividends in line with inflation, and they have been increasing them for the last 13 years. Now, dividend yield theory, as we can see here, a strong double undervaluation signal, and it is marginally above the real estate sector at that 13.5. In terms of their payout ratio, we can note that it has been below 90%. Nice to note, in 2024 expected 67%, so hopefully we can see in their next increase a high single digits. In terms of adjusted funds from operation, pretty inconsistent. The positive, we can note it has been increasing, chugging along over the last 10 years. 2024 expected to increase as well, and when we focus on that, they are expecting a strong year with a 17% increase to their adjusted funds from operations. Sales growth as well, above 5 to 10% nearly every single year, so that is positive to note. They are growing at a fairly strong rate, and we can see they have essentially nearly 4 times their growth over the last 10 years. Again, increasing shares outstanding, very typical for today's episode. In terms of the ROIC, the last few years it has been pretty low at 2%. This is something I would consider looking at year on year, quarter on quarter, just to ensure it doesn't slip and it does get to that minimum 3% level we want to see. Operating margin, it has come down marginally over the last 10 years. Again, something perhaps to keep an eye on, but still 25% for this real estate investment trust is looking healthy. Finally, the net debt to EBITDA below 5.5. Remember the blanket rule. It is looking to be below that in FY20. We do note it has been considerably above that year on year. Now, in terms of the valuation for this REIT, we can get to that today, which again is the average of these models, coming to $145. Now, margin of safety at 10%, a buy up to $130 at 15%, pretty much less than $1 shy. So for today's episode, a 15% MOS level, and upside 21%. Wall Street have that forecast of $150, and as we saw earlier, they do believe this REIT, out of all of them that we have seen today, to be a strong buy. The next REIT that we are taking a look at is Gaming and Leisure Properties. Now again, we note the double buy by Seeking Alpha Analysts and Wall Street. We see it down 16% over the last year. And in fact, this is now trading at its 52-week low with a yield of over 7% and a P to FFO of 11.39. Over the last 10 years, it is up around 18%, so not the best performer, but it does look like there is some nice undervaluation today. Dividend safety, 41, borderline safe, so we can check out these metrics. 12 billion large cap company, and the last recession, we don't have the data available. What's nice to note, they did increase it by 4.1%, so not only were you getting a very high starting yield, but you would have had an increase in line with inflation, although we do note it has been lacking over the last few years, and they have been increasing those dividends for the last 3. In terms of dividend yield theory, again, we get that double undervaluation signal, 7.04% yield, looking very attractive to income investors. And this is one that is actually lower than the sector P to AFFO at 13.5. Now, in terms of the adjusted funds from operation, we do note it went through an historical period of very high, above 100%, which would be a red flag indicator. However, over the last 4 years and expected next year, it is looking like to be under control. Adjusted funds from operation increasing over the last 10 years, although very inconsistent, and they are expecting a very small increase into FY24. When we look at it percentage-wise, we can see over the longer term, they have struggled for consistent growth. And in terms of the sales growth, they are at a minimum getting between that 5 to 10% for the majority of the last 10 years. So they have grown their top line, as we can see, nearly 3 times over the period. And again, shares outstanding, very typical, has been increasing. Probably the best ROIC metric we have seen, in fact, something that you would see from typical companies that aren't REITs, 9% over the last 2 years, phenomenal for investors, making this a very, very attractive proposition. Operating margin as well, it has been increasing over the longer term, a lot of operational efficiency. And when we focus on the net debt to EBITDA, granted, while the dividend did say borderline safe, given they have their AFFO payout under control, and we see the net debt to EBITDA coming down very, very strongly, 4.4 expected in FY24, there seems to be no red flag indicators at this high level. In terms of the valuation, as that is also important, we did note it did look to be a buy from those analysts. Intrinsic value just under $51. Now with a price of $43, we do start off with that 10%, and we can see $45.47. When we go to 15%, we can see pretty much bang on there. So 15% MOS level for JLPI, and we can see that in fact Wall Street believe the upside to be higher than our intrinsic value calculated at 22%. Again, indicating this to be another strong buy, similar to the previous four that we did run through. Now, as we mentioned at the beginning of the episode, there are a lot of REITs that you can buy that do look to be undervalued, but for those who prefer to have less risk, you can be looking at ETFs. Now, we have typically on the channel discussed VNQ, the Vanguard equivalent. We now have the Schwab US REIT ETF, another equivalent if you do want to look at investing in REITs as a group rather than individually. One of the strongest points about this is the low cost fund offering, as we can see 0.0% net expense ratio, which is very attractive. Ticker symbol is SCHH for those that are interested and want to take a closer look. And in terms of their holdings, well, we did just discuss Prologis, which does look to be undervalued with over 20% upside. We can see this makes up 9.1% of their portfolio, and typically with REIT ETFs, Prologis is normally up there as number 1 or number 2. And we have EQIX, which again is one that we did discuss today. Number 3, 4.5%. Lots of upside with this REIT. A lot of these other ones we have discussed on the channel that do show some very strong signs of upside as well. As always, though, do let us know your thoughts in the comments below. Have you been adding to any of these REITs? Do any of these excite you to a minimum put on the watch list? And as always, if you enjoyed the episode, smash that like button, hit that subscribe and bell button. And as always, we'll see you all on the next one.